financial statement, you know we said financial statement has two sides. We have the financial statement, we have the statement of profit and loss, and we have the statement of financial position. We are done with statement of profit loss, where we have to get our gross profit, then our net profit or profit for the year. So today we need to talk about the statement of financial position. And for statement of financial position, what does it really imply? It talks about the assets, liabilities, and the capital item of a business. So this is where you know the worth of the business. For the statement of profit or loss and other comprehensive income, they are about the trading aspect of the business. But here, it talks about what the business has and what the business is owing to others, is owing other entities or other businesses. So we start. Statement of financial position. This shows the assets and liabilities of firms over a period of time. It should recall that there is an accounting equation. Remember the accounting equation, which is asset equals capital plus liability, or capital equals assets minus liabilities. Okay. So for assets, why do we call them assets? We call them assets because they are resources that the business owns. It belongs to the business. These resources belong to who? The business. So we have two types of assets. We have current assets and non-current assets. For current assets, we're talking about assets that will only last within the operating year. That means for 1 year, that's operating year, that's financial year. So what is the essence of current assets? The essence of current assets is to get liquidity. That means how you spend liquidity. And when we talk about liquidity, it's something about easily turned to cash. So whatever we have in our current assets must be turned to cash within a year. That's what we're talking about here. Do you get what non-current assets is here? For non-current assets, they're not going to last forever in the business. The main objective of non-current assets is to be turned to cash and to be able to be used for the business. That's liquidity. So the main objective of non-current asset is for a current asset is liquidity, to be easily turned to cash. So examples of liquidity, examples of non-current assets or current assets, we have the stocks. Those goods that we want to sell in the business. It's going to last for within a year, and as soon as we sell them, what happens? We get cash. Yes or no? Trade receivable is another item in the current assets. These are those that are owing the business. As soon as they pay, what do they pay? They pay in cash or check, right? Cash comes to the business. Then what else do we have there? And other receivables. When we talk about other receivables, we're talking about prepayments. Here, some customers have paid us for the services that we have not rendered, but we still going to render those services in the future. Do you understand what prepayment is here? We call it other receivables. So that means we receive the cash, but we've not done the services. Is it clear? Great. Then we go to non-current assets. For non-current assets, we're talking about assets, resources that are in the business that can last for more than a year, that can last years. That is what we call non-current assets. Example of non-current assets, we have land, we have building, we have machinery, we have equipment. All these things can last for more than a year. Their own objective is not to turn them to cash. Rather, they have economic value and to stay in the business for as long as possible. That's why we call them non-current assets. Their own objective is not to be turned to cash. Rather, they are supposed to be used in running the business, and they are supposed to last in the business as long as possible. For current assets, they don't last more than a year. The main objective of a current asset, or the main essence of current asset, is to be what? To turn to cash as soon as possible. It's clear, right? Then we'll go to liabilities, which is another aspect of the statement of financial position. We're talking about liabilities. These are the amounts that the business is owing to third party or to other entities. So we have two types of liabilities. We have current liabilities and non-current liabilities. For current liabilities, why do we call them current liabilities? We call them current liabilities because we have to pay back this debt within a year. Do you get what current liabilities are? Same goes to current assets. Current assets are asset resources that are within the business for a year. For non-current for current liabilities, we have these are debts that we are owing to the third party that we have to pay back within a year. Example is trade payables. Those are credit suppliers that we have to pay back within a year. Another example is the bank overdraft. When you take more than your credit bank account, when you take more than what you have in your bank balance, that's an overdraft. You have to pay back within 6 months or maximum 1 year. You have to pay back. So all these ones and other payables. There's other payables. For other payables, we're talking about accrual, which is an expenses that has gone through the business, but the business has not paid for. That's accrual. It's still other payables. You have to pay for it also. Maybe in the future, but you have to pay for them. So all these ones are called current liabilities. Then we have non-current liabilities. For non-current liabilities, they stay in these are debts that the business will pay after a year. Current liabilities are debts that the business must pay within a year. Non-current are debts that the business has to pay after a year. Examples are the mortgage loan, bank loan that would last more than a year. Then we go to capital. Remember for capital, we said assets minus liability gives us the capital. So what is capital itself? Capital is the amount of money the owner of the business has put into the business. What's the interest of the owner of the business? What the owner of the business has tried to do with the business in terms of what it gives to the business. That's capital. So here the capital is. This is the amount put into the business by the owner. That means the owner of the business, you are the owner of the business. The amount of money you put into the business is called capital. Because the business has to be run as an entity. There's what we call business entity in accounting concept and convention. The business is different from the owner of the business. So whenever the owner of the business put money into the business, it is called capital. The money does not belong to the business. Rather, the money belongs to the owner of the business. Same goes to when the owner of the business takes money from the business. It is called drawings. Why? Because the owner of the business is not the same as the business. They are separate entities. So what happens with capital? Here I wrote, capital will increase if the company makes profit during the year and will reduce if the company makes loss. If the company makes profit in the year, that means you had it in your statement of financial position. Your capital will increase because you can have a retained profit or income. But when the company makes losses, you take it away from your capital, so your capital will reduce. Do you get the point here? If the company is making profits, the capital of the business will increase. If the company is running at a loss, the capital of the company will fall. Is it clear? Another thing that affects the capital is drawings. Drawings is when the owner of the business is taking certain amount of money from the business, or the owner of the business is taking certain goods, value of goods from the business. These are drawings. So it will reduce what? The capital. Do we understand? So these are what affects the capital. Profit or loss will affect the capital. Drawings will also what? Affect the capital. Either to increase or to decrease. Now we have a question here. Activity 7. We say these are items or descriptions. We could call them items, okay? So we have non-current assets, we have current assets, and we have liability. So, motor vehicle is an asset for the business, and it should last more than a year, yes or no? Yes. So it's what? A non-current asset. Cash, liquidity. You can't keep cash in the business. It has to be running through the business operations, yes or no? Yes. It is what? Current assets, thank you. Goods for resale. Correct assets, thank you. The goods you are going to sell them to what? To get cash? Yes or no? Amount to suppliers. Amount to suppliers. For amount to suppliers, what do we do with them? That means the amount the supplier is paying us. Is it an asset or liability? Amount to suppliers. The amount we have to pay the suppliers. Is it an asset? Liability, thank you. Non-current liability, right?
Thank you, Mr.
Amount due to suppliers, we said it already. Amount Bank.
No, amount due to customer.
Outstanding.
Amount, sorry.
Rent outstanding.
Okay, amount due to customers. Amount due to customers is the same as what? Trade receivables. Yes or no?
Yes.
Is it a current asset?
No current.
It's a current asset.
Yes.
Your customers are owing you as soon as they pay you. They pay you within a year, yes or no?
Yes.
It's a current asset. Trade receivable, that's the credit customers. They have to pay you, right?
Yes.
So as soon as they pay you, you have cash.
It's current.
It's current. We said the essence of current is what? Liquidity. To be able to return to cash within the year.
As fast as possible.
As much as possible, yes. So amount due to customer, current assets. Wait. Rent outstanding, you are owing your landlord liability. You are owing your landlord rent outstanding liability. Then we have bank overdraft liability. It has to be paid within a short period of time, but it's a liability. Office furniture.
No
The
current.
furniture here, this has been here for more than 3